Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over demographics real quick. I know in the last kind of thesis video that I did, or a long one explaining an answer to a question that somebody had on Twitter, this time we're going to get into the demographics. So what I do when you invest, well, what I do and what I look for is I look for big, long chart patterns. The big patterns describe the fundamentals and the way that people are thinking about the fundamentals over long periods of time. I think that they're some of the most accurate depictions of what could potentially come. A big, gigantic falling wedge that's ending a decade-long downtrend. The day-to-day stuff isn't as reliable because anything can move prices in the short term, but the fundamentals move prices in the long term. And what you want to do is you want to say, why are people putting in a bottom for commodities? Why are people putting in a top for technology companies or growth companies? Why? Why are those patterns being developed? If you can answer the why, then you can front run money flows as money flows differently under certain periods of time. The thing that I found that changes money flows is the demographic. The demographic comes into home buying years. It has that relationship with the housing market. If the housing market's underbuilt and you have a large percent increase of a demographic coming into home buying years, that's what puts it into a shortage. It puts the housing market into a shortage, which then increases home prices, increases loans against homes, and the new homes need to be built. New homes being built is inflationary, because you have a larger credit expansion in the system. So this is the demographics. We're going to look at the demographics. I'm going to kind of look at what the demographics are telling us potentially for what's coming in this next commodity bull market. And it doesn't mean, and I don't know if this just means like people can't grasp the concept sometimes. It does not mean, just because a demographic is present doesn't mean that the house prices have to go higher. And it doesn't mean that that when I say a pressure is there, it doesn't mean that everything just goes straight up. Things will still move up in waves. Things will still get slowed down by interest rates going up, affordability, et cetera, et cetera, et cetera. But the pressure is still there. The pressure for people wanting to buy homes, the pressure for them to buy new furniture or different furniture, new cars, money velocity, all that type of stuff. The pressures are there. So we talk about conditions, and conditions doesn't mean that you have 100% for sure outcomes. What it means is that the conditions are present for certain things, and the likelihood of those things occurring during the market conditions are a higher probability. So it's all probability and statistics. So I'm going to do is we're going to look backwards. We're going to play with some stuff with the demographics, and I think demographics are the leading indicator of all of it. And what I mean by is interest rates chase inflation. Now, what causes inflation? The demographics interacting with the housing market. That is the leading cause, which then reprices assets in the entire world if you're the reserve currency. I know that sounds weird. Every time I say it, it just sounds weird to me that a demographic interacting with the real estate market where interest rates go up or down, depending on that interaction with each other, prices all of the assets in the world. Because when interest rates go up, it prices bonds differently. When inflation is present, it prices the overall stock market differently, growth stocks, et cetera, et cetera, et cetera. So what I have behind me is the annual percent change in the US population from 1900 to 2021. The way that you read this is the baby boomers that were born from late 1930s all the way till a little bit after 1950s, but in the 1950s, we had a large demographic boom where the percent change in the US population is what really does it. It's a shock to the system. I know people say, well, it's the volume of the population. It's not the volume. It's the shock to the system that it gets. And volume is included into it, but it's a shock. It's a rapid increase in population growth in a very short period of time which shocks the system and puts it into a large shortage where home prices can expand dramatically, or where they need to create a bunch of new homes quickly. And that's what this large demographic shift was in the 1970s. You can even see in the mid-1970s, well, this is the 40s, you have to add 30 years because people, when they come into home buying years, there's a 30-year time delay. Because first-time home buyers aren't the age of 0, they're the age of 30 or 30 whatever. So I use 30 years old roughly. So it's 1970 is the beginning of this guy, all the way till 1980 is the peak. And that's that gigantic shift in the market. You can also see that in the 1940s, we also had, depending on what age they buy, another big boom in the housing market back in that time frame. So 1920 plus 30 years is 1950. So in the 1940s, when people were 25 years old or 20 years old, and the age of the age of first-time home buyers was a lot younger back when people were born in 1920s versus the 1940s and 50s versus what's now going on recently. And the first-time home buying age, the average age, continues to move to older and older. So we have to account for that in our calculations, and I'll show you what I have got on that. So this is the 1970s baby boomers, 1970s bull market and commodities. We had a large declining 40-year from 1980 all the way till about almost 2020, a large decline in the rate of population growth. We did have a small 2000s bull market from 1970, add 30 years, that's 2000. There's your small bull market. We call it a mini bull market, not a big boy. And now we've got a full breakout of the population demographic coming into home buying years, and this is what it is here now. But when you add that to the age, and we'll get into it, we'll put some projections on where the peak could potentially be based off of the demographic peaking. But again, it won't be perfect. It highly depends on when people are buying their first home, what age they are. It depends on, mainly that, what age they're going to be, and what that interaction between the housing market and the demographic is. If they choose to buy later, mid to late 30s, maybe it pushes a little bit to the right, and I've got some, examples of that. Or if it's more true to nature, I'll show you what it is if it was 30 or early 30s. But this is really what drives it, and we know it 30 to 35 years in advance is what the inflation could potentially be, using demographics as the leading indicator. So when we look at this, what I took is the population growth for the United States, the growth. And what I did is there's that large demographic that we were talking about. And one of the demographics born in 1984, it really popped up here all the way till 1992. That is the millennial home buyers. And what I did is I shifted the graph. I copied the graph here, and I'll just grab it so you guys can see it. I copied this graph here. I made a pattern of it, a replicate pattern, and then I put it over here and aligned the bottom of this graph where it starts to move up in a population change. And I added 30 years to it. Now, if you add 30 years to it, so this is 1984, add 30 years, well, yeah. 2004, 2014-ish. And then, now here's the thing. You want to shift the graph between 30 to 36 years to the right to account for home buyer's age. And if you look at this, what I have is the typical age of a first-time home buyer is 36, up from 33 last year. So it's somewhere between 30 and 36 years old if you were to take what the average first-time home buyer age is. So I can't remember what I added here. I guess it's 24 minus, I added 40 years, I think, to the beginning of it. Let me see if that's right. Pretty sure it is 60 years. It's not 60 years. Well, anyway, I shifted the graph over And I don't think this is in 1980. Yeah, it would be in 84. 84 plus 30 to 36 years. And what you get is you shift it over, you get a peak at 2025, all the way out, depending on what years you use, all the way out to 2028. So this graph can peak somewhere in this range. And I don't know what it's going to peak at because I don't know the exact age of first-time homebuyers and where that's going to necessarily peak out. I also don't know the interaction between the baby boomers that are passing away and the millennials coming into home buying years. I also think there's going to be some sort of interaction between it, and there'll be a peak somewhere between now and 2028. So that would be the peak. Really what we're looking at is the movement in, oh, there it is, the brush. This large, gigantic move in the population growth, and I just shifted everything over. So that's what we're seeing in the population, and that's kind of what I think is going on. And if you add, I'm trying to remember when I bought my first house. I guess I was like 34 or 33 years old or so. Now I'm just trying to think of it. But that's what we've got there. We also can look at some of these other metrics that we're looking at, like this is the gold to M2 money supply. And I put a graph up here as well. There's your graph showing you an ideal buy point and where we're located in that buy point for gold and a double bottom. This has that same type of pattern, gold to M2 money supply. And this would show if that demographic was coming into home buying years. It would show up somewhere low on this chart right now if we were entering a commodity bull market. I also looked at the, let me see here, there was one other, PPI to CPI ratio. We also have the PPI to CPI ratio. If you kind of look here, you can see a big downtrend, and then we get to that double bottom. And we went into a double bottom. This thing slid over a little bit because I've been sliding it. Right now, we're right where that circle is. So we're right at the bottom here. We haven't even gotten to point A in the breakout yet. We basically hit our head and came on back. And I think that's where point A is on the PPI to CPI ratio. And what that means, and this is a double bottom here. So we got the lead-in pattern. That's this little guy here, is this guy. And then we do 1, 2 bottom, 1, 2 bottom, and then we're coming on up and we're right where that circle is there. And the reason I'm talking about that is if this breaks to the upside, you want to look at the drivers of what's driving this. Is it the producer price index, which means there's a commodity shortage, and the shortages are going to drive this into a long-term uptrend where the commodity prices are going to continue to outpace the consumer price index, which means we go into a very inflationary period? Or is it something to do with our deficits? And the deficits are going to outpace how fast we can yank commodities and convert them into products. That would be another reason why the producer price index could go up at a faster pace than the consumer price index, is you just have money dumping into the system, or it's a combination of those two things where you have a little bit higher inflation into the system and commodities are a little bit constrained, and we get a long-term producer price index outperforming the CPI, which means you're going into an inflationary period for a good long time. That's what it means. It's a different looking world. But I also wanted to share that. And that's all I wanted to share today was the demographic interacting with the homes and the potential buyers out 30 to 35, 36 years old, what that looks like, what the potential top could be. So I do think that's all coming through. If you look at the figures that experts say that we're short on homes, because this is the demographic and the interaction between the real estate market and that demographic, it says we're short between 3 and 6 million homes. And that large demographics coming into home buying years right now, and that is what is going to potentially drive home prices and new homes, more new homes being built. It'll be more inflation. And the only thing that really can slow this thing down is the affordability and the interest rates coming on up. I would say it didn't slow it down very much during the 1970s boom. We had, in the 1970s, we had a very reactive market. We could build a lot of homes very quickly. We grew inventories very quickly, and it was kind of a very inflationary period because of that. The loans really expanded and the credit expanded during that time frame. Remember, these people are also buying a lot more things too. So the demand for a lot of things also went up, and we also had a problem with the increase of energy. We'll call it oil. Oil production in the United States had peak oil, and that peak oil, with the interaction of credit expansion, put a lot of things into shortage, which then is a very inflationary time frame. It's the same setup today. It's just worldwide now. We have a demographic interacting with our housing market, more credit expansion. You could say that even worldwide. It's the demographic interacting with the housing markets around the world, credit expansion, and then we're having shortages of potential commodities come up, which is going to be an inflationary period because commodities is what transfers this stuff into the consumer price index. And I did put the consumer price index here. This is a % changes in CPI for all urban consumers. And this is the categories that we look at for the consumer price index. This is what drags interest rates higher, is the consumer price index. So if I kind of zoom in here, it's food, food at home, food away from home. They've got energy, energy commodities, gasoline, fuel oil, energy services, electricity, utilities, piped gas service. We have all items, less food and energy. Commodities, less food and energy commodities. We've got new vehicles, used cars and trucks, apparel, medical care commodities, service, less energy services, shelter, transportation services, and medical care services. And these are the unadjusted 12-month ending 2022. It's a 6.5 for all items inflation number. But that's what's in the consumer price index. And the way that I see this is more credit comes into the system and it puts everything into a shortage, which is inflationary across the entire board like we've got going on right now. We can have certain commodities go up, but I don't think it's going to have a large overall impact to the consumer price index if you've got other sectors that just aren't going higher. So you could have real estate going down, like Japan's demographic, which is a smaller demographic than what was before. So their growth rates are going down, or they're even declining, where they're actually shrinking their population some. And that interaction with the housing market is down, 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 down. And that's why they can't get inflation. They can't get money into the hands of people. They can't get that credit expansion. They did have a little bit of a blip in their demographic, and they had a little bit of an increase of an interest rate and everything right at that blip. It actually turned out very well. You could read it 30 years in advance, 30 years plus. And it did happen. I think that was in 2016 or something like that, if I can remember. But that's how the consumer price index is being measured. And it's generally, all of these go up when there's more money in the system. So we'll see what happens over the next few years. We do have that demographic still in the middle of it. And we'll see what happens when all this comes and flows on through. I think it's going to be inflationary for a period of time. And when that demographic runs out, that's when problems could occur, or slowdowns could occur. We'll call it recessions, crashes, whatever. I don't really look at too much, and I don't know if you can even estimate it, is, how many people are migrating to America. This is all America-based for the most part, because a lot of commodities are priced in dollars, and that's the reserve currency. More dollars chasing fewer things is inflation in that currency. So that's what I've got for today. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't, and subscribe to the website if you like. Platinum membership discount is the coupon code if you want a discount. All right, guys, we'll catch you next time. This is Finding Value.